We warned you this moment was coming. We told you that when the banks began to lose control of the price, they would not simply stand by and allow the market to function honestly. We told you that when the short sellers faced extinction, the system itself would intervene to save them. And we told you that if they could not win the game, they would change the rules of the game. Today, they changed the rules. On Tuesday, January 13th, 2026, while most people were watching silver attempt to break above $86 an ounce, something far more important happened behind the scenes. The Chicago Mercantile Exchange, through CME Group, quietly issued an emergency advisory notice, notice number 26-019. To the average investor, this was just another boring PDF, a technical update, something easily ignored. But to anyone who understands how this system actually works, this document was nothing less than a declaration of war on the silver price. Effective immediately, the CME altered how margin requirements for precious metals are calculated. They moved away from a fixed dollar amount and replaced it with a percentage of notional value. For silver, that percentage was set at 9%. In plain English, this was a massive and deliberate tightening of the financial noose. With silver trading near $85 an ounce, this change instantly raised the cost of holding a single silver futures contract by roughly 15%. This was not a routine adjustment. This was a targeted strike. And the timing tells you everything you need to know about why it happened. The day before, silver went vertical. It gapped from $82 to $85, surged through electronic trading, and briefly pushed toward $86. Commercial banks, sitting on massive short positions representing millions of ounces of paper silver, were staring straight into the abyss. Losses were accelerating. Control was slipping. Something had to be done. So they did what they always do when the market moves against them. They raised margins. By doing this, the exchange forced every leveraged trader to make an immediate decision. Wire thousands of dollars in new cash right now, or have your position liquidated for you. It is a forced liquidity drain, a weapon designed to trigger cascades of selling by those who cannot meet the new requirements. This is not a theory. This is history. The same tactic was used in 2011 to crush silver from $50 to $35 in a matter of days. It was used again in 2020. It is the emergency brake the system pulls when price discovery becomes inconvenient. And for a brief moment on Tuesday morning, it appeared to work. If you look at the short-term chart, the moment the margin news hit trading terminals, silver collapsed. In minutes, the price fell from $86 to a low of $83.57. That move was not organic. It was not rational selling. It was algorithms responding instantly to a rule change, liquidating leveraged positions that could not survive the new cost structure. That was the sound of paper longs being wiped out. Predictably, the mainstream financial media seized on the drop. They declared the rally broken. They told you the fever had passed. They wanted you to see a red candle and feel fear. They wanted you to believe the story was over. But they were counting on you not looking closely. Because what happened next is the most important signal of this entire cycle. In 2011, margin hikes caused silver to collapse violently. 5 increases in 1 week resulted in a brutal 30% drawdown. This time, the CME imposed a single, highly punitive margin increase of roughly 15%, and silver dropped just a couple of dollars. And then it was immediately bought. Look at the candle, look at the wick. The price dipped to $83.57 and snapped back almost instantly. As this was being recorded, silver was trading near $83.90. It refused to die. That refusal is the story. This was the system's strongest weapon. They actively made silver more expensive to trade. They deliberately attempted to break the back of the bull market, and all they managed was a brief dip that was aggressively absorbed. That is not weakness, that is strength. So why didn't it crash this time? Because the buyers underneath this market are not leveraged speculators. They are not chart traders gambling on momentum. They are cash buyers, industrial buyers, sovereign entities. They do not care about margin requirements because they are not trading paper, they are acquiring metal. You cannot margin call a buyer who pays in cash. If a major manufacturer needs silver for batteries, electronics, or solar components, they do not hesitate because the futures margin changed. If the price drops, they buy more. A dip is not a warning to them. It is a sale. This is the fundamental shift underway. The margin hike hurts paper longs. It does nothing to stop physical demand. In fact, it helps physical buyers by shaking out weak hands and delivering cheaper metal into stronger ones. The silver market has split in two. On one side is the paper market, increasingly distorted by rule changes, leverage constraints, and intervention. On the other side is the physical market, driven by scarcity and necessity. One is a casino, the other is supply and demand. And the fire burning in the physical market is far too intense to be extinguished by paper tricks. But the margin hike was only the first sign of panic. While the exchange was busy changing the rules, something else was happening at a much higher level. Behind closed doors in Washington, alarms were going off. Reports emerged that Treasury Secretary Scott Bessent convened an urgent, unscheduled meeting with finance ministers from the G7 nations. The official explanation was innocuous: discussions about securing and diversifying supply chains. To the untrained ear, that sounds boring. Routine, bureaucratic. It is anything but. When a Treasury Secretary calls an emergency meeting during a commodity price spike and uses the phrase secure supply chains, it is code. It means the flow of material has stopped. It means inventories are depleted. It means the system is no longer confident it can obtain what it needs through normal market channels. This meeting happened for one reason. Silver hit $86. The Shanghai premium exploded. Physical inventories vanished. Retail demand drained mints. The global stock of the most conductive metal on Earth effectively went to zero over a single weekend. When governments talk about diversification, they are admitting dependence. When they talk about securing supply, they are admitting shortage. The reality is stark. China is one of the largest producers and refiners of silver on the planet. Russia is a major producer. The broader BRICS bloc controls a significant share of global output. The West, meanwhile, sold off its strategic silver stockpile decades ago. The United States has no silver reserve. None. It relies entirely on just-in-time delivery from a global market that is now fragmenting. Just-in-time is dead. We are in the era of just-in-case, and the United States has no case. This is not just an economic problem. It is a national security problem. Modern warfare is electronic. Missiles, jets, satellites, drones, communication systems, all of them require silver. It is the best electrical conductor known. Without it, guidance systems fail. Supply chains halt. Industrial capacity collapses. If silver flows stop, the military-industrial complex grinds to a halt. That is why the Treasury is involved. That is why this meeting matters. This is not about coins or charts. This is about whether the system can function at all. The response is coordinated. First, suppress the paper price to buy time. Then, quietly work with allies to secure physical supply off-market. Mining contracts, long-term offtake agreements, friendly jurisdictions. But there is a problem. China is already there. While the West focused on ESG scores and derivatives, China locked up supply. They signed contracts. They built refineries. They secured flow. The G7 meeting is not a show of strength. It is an admission of weakness. If they had the metal, they would not need to meet. And notice the shift in language. Silver is no longer described as a precious metal. It is now labeled a critical mineral. That reclassification is not accidental. It opens the door to intervention, to prioritization, to control. It sets the stage for rationing. When industrial giants and defense contractors need silver and the public wants it for protection, the government will choose the missiles and the batteries. They always do. Expect higher premiums, purchase limits, restrictions, public narratives about hoarders. The goal is to push private ownership out of the market. So when you see silver drop a couple of dollars because of a margin hike, do not feel discouraged. Understand what it really means. The same entities smashing the paper price are holding emergency meetings trying to figure out how to obtain physical metal. They are not trying to escape silver. They are trying to get it from you. And that tells you everything you need to know. The CME margin hike was never the real story. It was the distraction. The real story was the emergency G7 meeting. That is where the truth surfaced. The margin hike was theater. The G7 response was an admission. They already know the bond market is breaking. We saw that clearly with the recent forced liquidation of Indian holdings. Now they know something even more dangerous. The commodity market is breaking too. The system is fighting a two-front war against economic gravity, and gravity always wins. Just as the CME's margin hike failed to push silver decisively below $83.50, the G7 meeting will fail to create new supply. You cannot print silver. You cannot legislate a new mine into existence. You cannot hold a press conference and summon a metal deposit out of the ground. From discovery to production, it takes close to a decade to build a mine. No communique, no emergency meeting, no political decree changes that reality. Secretary Bessent can convene every finance minister on the planet. He can issue statements, frameworks, and action plans. But unless he possesses a way to transmute base metals into silver, he is out of options. The system's response is failing because the tools it relies on are obsolete. The paper tools are blunt, the political tools are slow, and the market is moving at a speed they can no longer control. This brings us to the most important question of the day. Why didn't it work? History tells us that when the exchange raises the cost of speculation, markets break. In 2011, margin hikes crushed silver almost instantly. In 2020, during the pandemic panic, margin calls amplified selling and drove silver into the low teens. The lesson seemed clear. Raise margins, force liquidation, collapse the price. But today was different. On Tuesday, January 13th, silver dipped to the low $83 range and then bounced. It refused to break. It absorbed the blow like a heavyweight who barely flinches after a full-force punch. The sellers threw everything they had, and the market stood its ground. The question is not whether the CME tried. It is why the attempt failed. The answer lies more than 7,000 miles away, and it is called the Shanghai Shield. While the CME was attempting to smash the paper price in New York, the Shanghai Gold Exchange closed its session with physical silver priced above $93 an ounce. That is nearly a $10 spread between Western paper pricing and Eastern physical reality. In previous cycles, this spread did not exist. In 2011, London, New York, and Shanghai were effectively synchronized. The market was unified. When New York sold, the world sold. That world no longer exists. The market is fractured. The West trades promises. The East trades metal. And because the East is willing to pay $93 for physical silver, the price in the West cannot collapse without triggering catastrophic consequences for the system trying to suppress it. This is the physics of the Shanghai Shield. If the CME were to succeed in smashing silver down to $70, would that end the bull market? No, it would ignite it. A $70 paper price in New York alongside a $93 physical price in Shanghai creates a risk-free arbitrage of over 23 per ounce. That is more than a 30% return simply for moving metal from west to east. Every serious trader on earth would step in. They would buy the smash in New York, demand delivery, ship the metal, and sell it into the Shanghai vacuum. The COMEX vaults would be drained in days, possibly hours. This is the trap the banks are now caught in. If they smash the price, they lose the metal. If they let the price rise, they lose solvency on their short positions. They must choose between saving the dollar-based pricing system or saving what little physical inventory remains, and the data shows they are losing the inventory. The depository reports released today tell the real story. While silver was being smashed on screens, the vaults were being emptied in reality. Over 500,000 ounces withdrawn from Asahi, over 600,000 from Brinks, hundreds of thousands more from C&T and StoneX. In a single day, more than 2.2 million ounces left the COMEX system. Even more alarming, the registered category, the silver available for immediate delivery, fell by nearly 400,000 ounces, leaving just over 120 million ounces remaining. This is the bleed. The margin hike did not stop it. It accelerated it. By smashing the price into the low $83 range, the CME inadvertently put silver on sale for the very entities draining the vaults. They are feeding the beast they are trying to starve. This is why the G7 meeting matters. Secretary Bessent knows the COMEX is bleeding. He knows metal is flowing relentlessly from west to east. That is why supply chains are suddenly the top priority. They are trying to build fences after the flood has already begun. But you cannot fence a market when a $10 price gap exists. Capital is fluid, metal is mobile. It flows to where it is treated best. Right now, silver is treated best in Shanghai. That is why the Shanghai Shield matters so much. When you see volatility, when you see red candles, understand what you are really looking at. Those moves are crashing into a concrete floor built by Chinese physical demand. Unless the Shanghai price collapses, and there is no evidence of that given China's industrial needs, the Western price cannot sustainably break lower. This creates an asymmetric market. The downside is limited by arbitrage. The upside is unlimited because the paper shorts are structurally insolvent. For the first time in a century, New York no longer sets the silver price. Shanghai sets the floor, and New York struggles to keep up. The margin hike was a desperate attempt to reassert control. It was the empire reminding the market who it thinks is in charge. The market responded by looking at $93 silver in China and realizing the emperor has no clothes. Paper tools only work when the physical market is asleep. But the physical market is wide awake, it is hungry, and it is consuming the COMEX from the inside out. The millions of ounces leaving the vaults are not coming back. They are being fabricated into solar panels. They are going into electronics, batteries, defense systems. They are gone forever. This means the system response has now failed on two fronts. Financially, margins failed to break the price. Physically, inventory is vanishing faster than it can be replaced. So what is left? If they cannot stop the price with paper and cannot secure supply through policy, there's only one option remaining. Close the gate. Make it harder for the public to participate. Prevent retail buyers from draining what little inventory remains. And that is exactly what we are now seeing. Look at Costco. For years, Costco acted as a pressure valve, allowing ordinary Americans to acquire silver easily. That era has ended. We now have confirmed reports of strict transaction limits. One transaction per membership, hard caps on units. That is not capitalism. That is rationing. Retailers only limit sales when they are terrified of running out and cannot restock. Costco knows that if sales were unrestricted at current prices, their national inventory would disappear in hours. Now look at the U.S. Mint, the official supplier of constitutional money. The 2026 Silver Eagles were released and immediately sold out. New orders are delayed by at least a month. Back-ordered. Think about what that means. The United States government cannot mint enough 1-ounce coins to meet demand. That is not a marketing issue. That is a supply chain failure at the sovereign level. But the most damning signal of all is appearing inside the futures market itself. We are seeing backwardation and, more importantly, backward rolling. Instead of rolling positions forward into later months, traders are fighting to stay in the delivery month. They want metal now, not promises later. Delivery notices surged, yet open interest barely declined. That means for every trader exiting, another is stepping in, desperate to secure immediate delivery. They do not trust that the silver will be there in March. This is a textbook squeeze. The shorts are trapped. The longs want metal. And the exchange is desperately hiking margins to force separation. So what is the verdict on this historic day? The system response failed. The CME fired its margin bazooka, and silver is still trading near $84. The Treasury convened the G7, admitting vulnerability. Retailers have begun rationing. Vaults are draining. Futures contracts are screaming stress. They tried to break market psychology today. They wanted fear. They wanted capitulation. They wanted you to see a red candle and sell. Instead, the Shanghai Shield held. Physical buyers stood firm. And this $83.90 price became something more than a number. It became a signal. It marked the moment the market collectively realized that the banks are powerless against a genuine physical shortage. If you already hold physical silver, do not let them scare you out of it. A 2 dip caused by a rule change means nothing in a market where governments are scrambling for supply. If you're trying to buy, understand the reality. The window is closing. Rationing has begun. Premiums are rising. The easy silver is gone. The resistance at $80 is gone. The resistance at $85 was tested and survived. The next true resistance is the Shanghai price near $93. That gap will close. Not because of speculation, because of physics. The empire struck back today, and the empire missed.